thank you. And before Tanner jumps into his presentation, on behalf of the Farm Credit Associations of Kansas, we're glad to be here. There's 4 associations in the state of Kansas, and we're really proud of serving. I think we have over 14,000 shareholders. We lend about 5.6 billion in capital to producers in Kansas. And this last year, we kicked back nearly $45 million in cash patronage back to our stockholders. And we think the business model is really, really beneficial to producers, and we're glad to be here. More importantly, we're a proud supporter of the CARL program. We believe that leadership is fundamental to any organization, whether it's a family operation or an ag business or a volunteer group. So on behalf of our 4 associations, American Ag Credit, Farm Credit Western Kansas, Frontier, Farm Credit, High Plains Farm Credit, we're glad to be here. And I'd like to give a special shout out. I saw Doug Hoffbauer on the call. He's a former CEO of Frontier and retired, and I haven't seen him in a while, so I want to say hi. So with that, Tanner, it's all yours.
All right, thanks, Bob. Thanks, Jill, and thanks everyone for joining this evening. And so CoBank, just to make clear, our relationship with the associations in Kansas, we're the funding bank for all the Kansas associations and all the associations out west. In addition to being the designated bank for co-ops. So if you do business at your local co-op, you're probably doing business with a CoBank customer. So we have a unique view of what's going on in the ag economy because of our relationships in farm and ag lending, and then with agribusiness. And this past year has been a wild ride. We've at CoBank, being the largest lender in ag in the U.S., we've had quite an experience over the past year, and we're preparing for another interesting year. It's just going to be different in 2021 as we recover from COVID. And obviously that COVID is going to continue to be the story of the day for us in agriculture, well, for everyone really, but agriculture has a unique place in this economic recovery. With that, I'm going to share my screen here. And if everyone just can bear with me for one moment. Oh my goodness, here we go. Great. Some more technical difficulties. Almost. Here we are. Sorry, everyone. All right. Can you see my screen?
Yep. Yes.
Okay. Excellent. All right. Well, we'll go ahead and go to the slideshow. So moving right along, the way we typically cover this, we have to talk about what's going on in the macro economy. It's basically what's going on in the world economy and the U.S. economy, and how COVID has changed everything for us. And then we'll move into the agricultural markets and our view on the agricultural economy. And we'll really drill it down here locally to what's going on in the central and southern plains and Kansas. But first off, just one chart here on the global economy. Everything, again, is COVID driven. These are the last outlook by the OECD on how they expect the global economy to recover. Clearly, the world is not the same compared to where they were projecting the world economy pre-COVID. It's a smaller economy. It shrank because of COVID and all the shutdowns and lack of spending from consumers. But a significant recovery is in order. Now, that is depending upon how vaccinations are rolling out around the U.S., or excuse me, in the world. Here in the U.S., vaccinations have gone very well for the most part, not always, but we're doing a lot better than other countries, and that means our economy is going to open up faster. What that means then here is that if our economy is going to be growing faster or recovering faster, that means consumers are going to be consuming more agricultural products, and also that means a stronger U.S. dollar, which is very impactful on our exports. And we're going to talk about that here in a moment. There's a few things that we have a little concern over, and that's all these new variants of COVID. You've got the South African version, you've got the Brazilian variant, you've got the British variant, And all of those COVID variants are going to have um, differing responses to the vaccinations. And this is something that we're going to have to manage going forward. Um, and some of these variants could in the future could be a lot more lethal. And so hopefully we will have learned from this last time around with COVID how to manage a pandemic, and that future pandemics will not be nearly as economically crippling. But keep that in mind. This is not going to be the last pandemic. We will have more in the future. Here we are, just a recap of where we are in the U.S. Hospitalizations are way down. We have learned how to manage COVID. Cases are way down compared to where they were weeks and months ago, but we are seeing an uptick in some states. Nonetheless, everyone is preparing to reopen or trying to reopen their local and state economies. And that's coming in fits and starts, but some areas are doing better than others. And as you can see in this map right here, cases of variants of concern in the U.S. on the top right graphic there. Some major economies like California and Texas are struggling with some of these new variants. And so how they respond going forward with vaccinations, and if they want to do more lockdowns, or if consumers decide to not go back to work because they're in fear of contracting the virus, this is going to be impacting our economic growth in the future. But right now, as it stands, we're in a much better position compared to where we were just a few short weeks ago. And that is the positive news. And so we'll take that as the win going forward, that we're going to continue to see progress with COVID, and that we're going to see progress economically. So I got to talk about, first of all, how we spend our money as consumers. This has fundamentally changed, and this is going to tie directly into agriculture. The line I want to direct you to is the top red line. That's durable goods. Look how that line completely shot straight upward. What are we talking about when we say durable goods? Those are things like Pelotons, lawn furniture, computers, bigger computer screens. With everybody in lockdown and at home, they had nothing better to do than to spend their money on newer, better things for their home. And this is going to have a direct impact, or it has had a direct impact on how the global economy has functioned. And so keep this chart in mind. We're going to touch back on this here in a moment when we talk about containers. I'll have a picture later on, but with Americans buying all of these durable goods to outfit their homes for quarantines, or if they're officed at home permanently, like many of us, like many of you who are, if you're not in production agriculture, if you're like myself, for instance, or Bob, a lot of us are at home now permanently or for an extended period of time, and we may never go back to the office. Well, if all these people are going to be stuck at home, they're not going to be going to the gym. They're going to be spending more time at home and in their backyard. And so this could be potentially a lasting impact on the economy, and this is going to impact global trade. So we will come back to this here in a moment. As for the U.S. economy, we saw phenomenal recovery last year following last year's collapse in the U.S. economy and economic growth, and that growth is expected to continue. Now, we've got a few other things here that we have to take into consideration. We've got phenomenal government spending, and we've got the consumer that is ready to go out and spend more as well. But right now, the U.S., or this is from the Federal Reserve, their projections are that we're going to see some really strong growth in quarters ahead, upwards of 6% for the U.S. economy. That is an astonishing number, historically speaking. This country has gotten used to numbers of 2 and 3% annual economic growth, and the Fed is projecting double that on a recovery. That's not sustainable, as you can see here. The Fed's projection is that we're going to see the growth rate slow. But nonetheless, it is a recovery, and that means we're going to see a stronger consumer and some changes in behavior and consumption habits in global trade. Unemployment as well is going to continue declining. We've had a a big recovery in the amount of people going back to work. But keep in mind, this is the headline unemployment number. This doesn't, first of all, what is unemployment? What is the definition of unemployment? Is people who are looking for jobs and cannot find one. Okay, that is a person who is unemployed. What about somebody who had to quit their job so they could stay at home and raise kids because the schools were closed? They had to do homeschooling. Does that person count as unemployed? Technically, no. There are a lot of people who have been sidelined in this economy because of COVID. The economy is fundamentally different. Labor force participation rate is much lower. It's at historical lows. And that's of concern. There's also a lot of people who are not going back to work because they are simply scared of getting sick from COVID. So there's going to be a lot of people sidelined in this economy. And there's been a lot of talk of the quote unquote K-shaped economy, where we see the economy rebound like this on GDP and consumer spending and income. But there's going to be a lot of people on the lower bound that are not going back to work because the restaurant perhaps they used to work at is closed permanently, or perhaps the hotel they worked at is closed permanently, or their lifestyle has changed where they have to stay at home and spend more time with family, or they just don't want to go back to work in fear of getting sick. And so those people are going to be counted not in this, they're not going to be counted in the unemployment number. And so we're going to come out of this with a drastically different economy than what we had before. Consumers also learned to save at a level that they've never had before. Think about our grandparents or parents or grandparents, perhaps, who survived the Depression. Okay. What ethics did what consumer habits did they adopt from years of crushing economic conditions? They became extremely frugal. And that is what we're seeing here. We are seeing consumers adopt frugality at a level we have not seen since we've started collecting data on this going back 50 years. And so, again, psychologically, we're dealing with a new and different consumer. People who are not going to be willing to spend like they used to. At the same time, though, you're going to have a lot of other consumers who were gainfully employed throughout this entire period, and they are ready to spend all of this money that they have been saving throughout the pandemic because they were not going to restaurants. They were not buying new clothes for the office. They were not commuting to the office, and they were not traveling. And so that's money that they were saving, not spending. And as we enter into the spring and summer months, and as COVID recedes, we're going to have a consumer that is going to be spending, be ready to spend a lot of their savings. At the same time, we've got government stimulus, which we're going to talk about here in a moment, and we're going to tie all this into the big I word of inflation. Moving right along, the government's role in this has been unprecedented. I don't think this is news to anybody. Federal deficit last year was record high, 3.1 trillion. We may exceed that potentially yet again this year with the 1.9 trillion in COVID spending in the last bill. Then we've got this infrastructure spending bill that we'll see how that gets funded. That may be funded through higher taxes. If it's not through taxes, it will be through more deficit spending. At the same time, if you look over here on the right side of this graph, you see federal debt as a percentage of the GDP, just a phenomenal level of how much debt this nation is carrying. At some point, this is going to have to get paid off. And when that day arrives, it's going to be ugly. And I don't think there's going to be any politician out there who's going to want to face that, or taxpayer who wants to face that. But needless to say, for the time being, the government has had phenomenal deficit spending, and that is going to contribute to and continue to contribute, if the government continues to spend at a deficit on a deficit level, to this concern, the rising concern of inflation. And I'm going to pause there for a moment. Jill, are we having some? I think I saw some questions come in, perhaps, on this.
Yeah, there's a couple of questions here, Tanner. One is there evidence of people choosing not to work because government payments are more lucrative than working? This is from Ron Wilson. He's heard it anecdotally.
Yes,
Didn't.
that has been a concern. That has been a problem back when the last stimulus, when we were getting $600 checks, when you could get that in addition to unemployment benefits. We had CoBank had customers that were struggling with this issue because agricultural workers. We're talking about the folks out there, picking broccoli, picking apples, things like that, or manual labor out in the fields. A lot of those folks did not have to go to work because it was more profitable to just stay at home. And we can't fault them for doing that. I mean, anyone would have made the same decision. Why go to work and risk getting COVID when it's more profitable to be safe at home? And so a lot of people did choose that. And anyway, at any rate, that was a problem for a lot of folks trying to find workers, and that will delay the reentry into the workforce for a lot of people, unfortunately, and delay the recovery. But at the same token, those people also have more cash in their hands, and they may be spending it at the same time. So it's going to give and take there. Preferably, you'd like to have those people working and not just spending on government deficit spending as well. At the same time, that just kind of complicates the situation. But yeah, that was an issue for sure.
Tanner, a couple of more questions. How have you seen newfound consumer frugality to translate into demand for ag products at the retail levels versus wholesale or food service?
Yeah, great question. So the frugality is going to be those people who don't have money, who are shocked economically. There's a lot of people who this is their second time in the last, call it 12 years of being long-term unemployed. Back in 08 and 09, they perhaps lost their manufacturing job, or a lot of people lost jobs. And then this time around, so many people in the service sector lost jobs, and those are not the highest paying jobs. And so psychologically, those people will have definitely learned frugality. And so it's going to be the wholesale consumer. They're going to be buying bulk if they can. And so, that's part of the K-shaped recovery, that downward, the downward sloping group of consumers that were so shocked economically that they may never recover, ever. Their consumption habits are going to be quite different than those who were gainfully employed. So again, people talk about how this pandemic perpetuated or accelerated existing trends. And one of those trends, unfortunately, was the widening gap between the wealthy and the non-wealthy. And we're seeing that play out now, unfortunately.
Right. And
so two different psychologies.
It kind of rolls into this next question. And Kelsey, pipe in if you have just need more clarity for this. The labor force, spending changes, et cetera. How does that differ across classes of individuals?
Yeah, I don't have any slides on. That's a great question. So we're talking about like labor force participation rates among income classes.
Yeah, I mean, I think you touched on it, Tanner, in the last question. I was just thinking about like the income classes, and I mean, as you said, it was a widening gap, and that's what I was interested in, is that there's some that this has projected them ahead, and then there's others that have been set behind, and like you said, might be perpetually that in that category.
Yeah, it's going to be interesting once we get more data. The Fed tracks a lot of this about how these people are going to re-enter the economy, and we're going to find out that there's a lot of people who will not be re-entering the workforce, unfortunately. And how do they live? How do they spend their money? They probably moved in with family members. They might be doing part-time jobs that are in the gig economy that may not be recorded as full-time employment, just kind of scraping by. those consumers, unfortunately, are not going to be the wealth accumulators, not going to be owning homes, buying cars, etc. They're always going to be renting and borrowing somebody else's car to get around, perhaps. So, anyway, that's going to be closely watched about how this shakes out, and I'm sure politically this is going to be very interesting as more of these people realize that they are going to be long-term unemployed. What do they expect from the government? That may be an interesting turn of events in the next presidential election. All right. Should we go ahead and move on, or any more questions, Susan?
There's one more question here. Do higher tax rates really generate more tax revenue for the U.S. government? And then it also appears small businesses, including ag, are potentially paying more tax than larger corporations will pay, and at the same time makes us less competitive in the world markets.
Right. Yeah. So there's talk of the tax rate going back up to, I think it's 28%, is what Biden wants to raise it to, the corporate tax rate. And we'll see what happens there. I have a hard time answering that. I don't have the numbers in front of me, so I couldn't really give you a very much of an intelligent answer there. I do know that this is a concern about estate planning. This is something that Bob and I have talked about, and something that Bob might can comment on later. But that has raised some concern about estate plans. So now, whether higher taxes generate more revenue, I would assume so, but it depends upon who's paying it, and how many people fit into that bracket that's being taxed more. So I don't have any in-depth numbers on that, so I hesitate to comment further on that.
Okay, thank you. That's what's in the question chat for now, Tanner, if you wanted to move on.
All right, yeah, we'll go ahead and move on. So we just talked about the federal government's role. Here is the Federal Reserve's response to COVID. Interest rates dropped to zero, and the Federal Reserve balance sheet went bonkers. So if you look back on the right, if you look at the right chart there, look at where we were when the Federal Reserve and Ben Bernanke embarked on quantitative easing, which is just a fancy word for printing money and buying debt, buying public debt, or in this case, they expanded it to private debt. But back in 2008, we saw almost $1 trillion in quantitative easing. And now where we are now, if you look at the right side of that chart, it is well over 7 trillion. Just a phenomenal amount of quantitative easing going on. That is the Fed just injecting tons of liquidity into the economy. This is in addition to the federal government's deficit spending. There's no coincidence here about the Fed's balance sheet and the deficit spending of the federal government. It was the Fed buying a huge portion of our public debt in an effort to try to keep interest rates down. Or try to keep things balanced. Had the Fed not been there, it may have been a little bit a different scenario. But they're trying to keep interest rates affordable for the federal government and for the consumer. And this is what it looks like. And when you print all that money, this is a chart of the money stock from the Federal Reserve. 41% of all U.S. dollars ever printed were printed in the last 12 months. It's a phenomenal amount of liquidity. And we don't know where this is going. This is uncharted territory. We thought we were in uncharted territory back in 08 and 09. Now we are really in uncharted territory. This is going to have to invariably draw some measure of inflation, right? Is this going to be like the inflation we saw in the 1970s? Nobody really knows because we just haven't seen this. We don't have a benchmark for this to measure against. So this is something that the Federal Reserve is going to continue. They have stated they're going to continue on quantitative easing. They're going to continue with very low interest rates for the foreseeable future. So there's no indication yet that this is going to turn around. So there's just a ton of money out there sloshing around in the economy looking for a home. And in addition to federal stimulus spending, so there's going to be some measure of inflation. Some of
Tanner,
you maybe.
Tanner, would you say generally graphs that have a hockey stick to them don't usually pan out well?
Normally not. I mean, unless, if you, GameStop, remember, or GameStop here recently, with that one hockey stick, and then it went completely belly up, right? All these phenomenon of the hockey stick, as Bob is alluding to, typically doesn't end well. A lot of economists will tell you, you want to take your pain up front, not later. This may be an indication that we're going to have a lot of pain later once this corrects. Again, going back to the scenario, we're going to take a look at inflation here in a moment, but the concern is that this liquidity is going to drive inflation, and that we may have to end up in a situation where we had Paul Volcker, who was appointed chairman of the Fed under Reagan, and his job was to control inflation. And how did he do that? He went Genghis Khan essentially on inflation, and declared that the enemy, and raised interest rates phenomenally. I thought a lot of folks may remember that, the 1980s farm crisis, and some are drawing some parallels here that this may be where we may be going in the future. But I can't tell you where this is going to go. Again, it's uncharted territory. It's just going to be interesting to watch for sure. The Fed, as I said earlier, this is the dot plot from the Federal Reserve Board of Governors, and every governor has one vote, and that is represented in each of the dots. And as you can see here, the Federal Reserve, each of the board governors has indicated that they are expecting very low interest rates at least through 2022 and perhaps through 2023. Now, a lot of bankers may readily point out, yeah, that's what they think right now. What if inflation does become out of control, or does go out of control? Then this changes quite radically, and the story could change quickly. That they may want to raise interest rates faster than what they had anticipated. But this is what they're predicting right now: low interest rates at least through the next 2 to 3 years. So on to inflation. As you can see here, this is the consumer price index chart. At the far end, at the far right side of this chart, you can see that we're starting to see a bounce in consumer prices. And the Fed's target is 2%. Right now, in March, it was 2.6%. The Fed has already indicated that they're going to tolerate inflation over 2% for quite some time. Why? Because for so long, inflation has been so dormant. And so they're going to allow inflation to run hotter than their target rate of 2%. So already we're starting to see prices start to pick up. We'll see how long this lasts. If you look on the left side of the chart there in the 1970s, you can see what happened to inflation and why we saw the Fed respond with such strong interest rates in the 1980s. And it was Paul Volcker, again, who drove inflation down at the beginning of the 1980s with higher interest rates. Now, we are a long ways from that situation, but the concern is that we could end up in a situation like that before too long. This is what it looks like on other commodity prices. We've seen a bounce across the commodity spectrum, and indeed across almost all markets. We've kind of been in what they call an everything rally. Crude oil prices bounced in the middle of the pandemic back in April and have recovered since. It's the same with copper and lumber. If you're trying to build any facilities on your farm, any construction project, you know that the cost of construction materials is not going lower. And this has got people thinking of the the S word of super cycle. And we got to be cautious about that. This is a chart on the S&P GSCI. This is the Goldman Sachs Commodity Index. And at the top left corner of the chart, you can see how the index is broken out. Most of that is in energy. Agriculture is 16%, livestock is 7%. The U.S. dollar index is clearly has an inverse correlation. When the dollar is weak, commodities are high, and when the dollar is strong, commodities tend to be weak. This may be a different situation. Here recently, we've seen the dollar rising in tandem with rising commodity prices, which is an odd relationship to see. So again, we're in uncharted territory with this economy. We'll see what happens. But needless to say, prices are rising across the commodity spectrum. And that has gotten people to talk, that's raised this talk of the super cycle. We are not so certain about that. I like to pull up this chart about historical corn prices. This is looking at the price of corn going back to the 1860s. Corn has been a very reliable, and wheat at the same time, corn and wheat follow the same pattern here. Very reliable indicator of super cycles. And super cycles happen every couple of decades, typically. They do not happen very commonly. They're not very common. They follow typically a couple decades of low prices. Then you see demand pick up, and then prices respond. But a little bit of further explanation on this chart is you can see these gray areas. Those are the periods of when prices corrected to the upside. They're very momentary places in time. They don't last very long. And then we achieve a new normal, which is those valleys in between. And you can see in these, the red numbers there, those are the new normal price levels in between the spikes. And there's no indication that we are in a new super cycle. It just looks like a bounce off of new lows. This follows a very typical pattern of a correction. If you look on the right side of the graph, prices spiked up back just a few years ago. I think we all remember how well that went. Prices collapsed, and then we thought this is the end of the golden age of agriculture. And then you see a rebound. And that's kind of what you see every single time. Look at the gray bar for every super cycle period. And once they bottom, they rebound back up. That's not the beginning of a super cycle. That's just establishing a new plateau. So we're not convinced that this is a new super cycle at all. It's just a typical pattern that you would expect in a rebound. Indicating that we've reached a new plateau. Okay, moving quickly along here, we're just going to cover some of the major markets. These are agricultural export prices as measured in an index from the Federal Reserve. And there's a clear association here, as we saw in the GSCI commodity index, but this is looking just at agriculture. When the dollar is down, agricultural commodity prices are up. Things are a little different this time. Look at that green line at the lower right-hand side of the chart. And we have really seen a sharp recovery in agricultural export prices. So it's not just the dollar that is going on here. I think we're all well aware of other dynamics. We've got the Chinese, who have been phenomenal buyers throughout this period, and that has coalesced with a weaker dollar. And so it's not just the value of the dollar driving this. There are those fundamental factors of the Chinese trying to rebuild their hog herd and demanding more feed. And that is also going to be driving commodity prices until the Chinese have their hog herd fully recovered from African swine fever. Again, China has been the big story here, in addition to the weaker dollar and the fundamentally different economy from COVID. This is looking at total Chinese exports on a dollar value versus the rest of the world, and China has really stepped up. It's not just feed; it's almost everything. If you look at across the commodity basket, they're buying animal protein, they're buying plant protein like tree nuts, anything that is an agricultural commodity, the Chinese have been buying it. Part of that reason is their economy has been very strong. They recovered faster than the U.S., and they have a stronger currency, and so they can purchase more with the stronger yuan. And so at the same time, they're trying to rebuild their hog herd, and so soybeans are a big component of this. So across the board, the Chinese have been major consumers, and that is we can't let that. We can't lose sight of that, because one day the Chinese are going to slow down their purchases. Exports are already slowing down. A lot of this is just seasonal. They're shifting their imports down to other exporting nations like Brazil with the FSU. And, we're going to continue to see a strong import pace. It's just not going to necessarily be from the United States. Moving on to exports, on how we've been impacted by this this shift in dynamics globally, as I mentioned earlier, with durable goods. We've seen a big increase in bulk products, but we have not seen a similar increase in high value products. It has recovered, but the Chinese typically are just wanting soybeans to crush for feed. It's been a challenge to try to export higher value products, for instance, like almonds that are shipped in the containers. That's been a more difficult. It's been a challenge because people simply cannot get containers. This is been a big issue for also dairy and livestock, and so this is going to continue to be an issue as long as we see a shortage of containers. Trade in goods with China. We've seen a big import, again, durable goods, whereas our exports have not responded in a similar manner. Again, trade logistics is a big part of this. And just a little bit on this. I think everybody has seen these on the back of trains, the 20-foot containers. We send a lot of agricultural products through these type of containers. And just a little bit of background information on this. The Chinese have been paying about $4,500 for these containers. We can only afford maybe about $500 to $700. And so what happens then, if you're a carrier or a shipping company, you say, why am I going to be wasting my time on the Americans? I'm going to load this container up onto my ship empty, send it back to China where I can get a lot more money for it, load it full of Pelotons and computers, and then send it back to the US. And this has been a problem with a lot of agricultural exports stuck at the ports, and they're not getting loaded on the boats. And this has been especially a problem in the dairy commodities and animal protein, where things may not have much of a shelf life. And so if you can't ship it out very quickly, as the saying goes, sell it or smell it. You're going to be smelling a lot of agricultural products at the port. And so you're going to want to they're trying to turn these around and trying to find a use for those products in the US. So we've lost about 1.3 billion is the last estimate I've heard of ag products rejected at ports. And a lot of that stuff just went bad. This is what the ship lineup looks like at the Port of Long Beach. Huge wait times. It's a couple of weeks, if not longer, to load a ship. And so they're saying, don't give me that. Don't send that container. Don't load a full container on my boat. I don't have time. Just load it empty and go back to China. I go. And if you thought we had problems, look at China. This is the vessel traffic outside of Shanghai, and this is what they call a nightmare. There are so many boats trying to pick up durable goods and bring them back to the U.S. And there's no sign that this is slowing down. In some instances, the ship lineup has shrunk, but because consumers are still buying so many things off of Amazon, it has really snarled global trade logistics. And another measure here, the share of imported containers at the Port of Long Beach and Los Angeles waiting more than 5 days has gone way, way up. So no surprise if those computer screens that you ordered off of Amazon might be taking a little bit longer. This is why. There's too many ships lined up outside the port. And if you are an agricultural exporter, another reason why you're not able to get a container, it's because it's still sitting on the boat waiting to unload. This has also contributed to rising shipping rates around the world. This is the Baltic Dry Index. This is an index of shipping rates for things like Panamax vessels that are loaded full of corn and soybeans and sent through the Panama Canal. Shipping rates around the world continue to go up, adding further problems to global trade. In addition to the wait times, you've got to pay more for all kinds of shipping, not just containers. Ocean freight rates from the U.S. to Japan, if you want to load wheat, even though wheat is not necessarily being sent on containers, doesn't matter. Shipping rates are going up, and so it's going to become more costly to send those agricultural exports overseas. Another chart here on China. We're getting close here on time. I'm just going to move ahead just on these slides. Stop me if you want to talk about any of these. But again, China has been the major driver in grain markets. And in addition to the shipping costs and China really kind of becoming the 800-pound gorilla in the room, this is potentially causing some concern about reliability of the U.S. as an exporter. If China is the 800-pound gorilla in the room, taking all these agricultural exports, and we have longer wait times at our ports, and we cannot get containers, some of our other customers around the world are saying, can we really rely on the U.S. as an agricultural exporter? And some are concerned that we may be ceding market share to other countries longer term. Moving on to the situation here in the U.S., the Chinese have bought so much grain from the U.S. We've got a much tighter supply. I think this is all no news to anybody on this webinar. That has driven commodity prices to new highs, multi-year highs. I think we have all seen these on a daily basis, so I'm just going to click through these very quickly here. And that's going to drive an acreage expansion this spring. This is going to be pretty interesting. CoBank gathers a lot of data with our farm supply customers, and it's interesting with the chemical and seed and fertilizer sales that we've seen heading into the planting season. There is clearly plans for farmers to try to get as much to apply inputs on the acreage that they have, not necessarily expanding the acreage, but they're going to be spending more on it, trying to chase higher yields. And so we'll see what happens. Everything, of course, relies on the weather. Moving on to some of the agribusiness. Oh, I'm sorry. I'm going to pause for a moment. Susan, do we have any questions that we need to address first as I move forward?
There's Rich added a question, containers backed up at the ports. If you want to back up to that for a minute, Tanner,
Sure.
Is COVID affecting dock workers part of the problem? Should
Yes.
the problem kind of subside when people are vaccinated? What's going to help alleviate that?
Yes, good point. Absolutely. Dock workers did not want to show up to work because there were outbreaks of COVID at the docks. Same thing with truck drivers. You couldn't get truck drivers because of COVID. I heard recently that the Port of Long Beach has a vaccine rollout. They're trying to get all the dock workers, about 15,000 workers, all vaccinated here in the next couple of weeks, so they can try to alleviate this. But then you've got the truck drivers as well. There's a shortage there. So even though we may have dock workers vaccinated, are the truck drivers going to come back? As that may continue to be contributing to the logjam going forward. but there is an effort to try to bring those workers back to the docks and try to alleviate some of this congestion. But that is a very good question. They're working on it. Any other questions?
I think that's it for now. Bob did respond to that too with the recent article from the Wall Street Journal, if people want to reference that regarding the labor issues. Thanks, Bob.
Yeah, thanks, Bob. So moving along, agribusiness, looking at some of the end users, ethanol production clearly down. That is the green line there, despite the fact that ethanol prices have come back. Ethanol prices have followed gasoline prices as people start hitting the road more. But remember, the economy is fundamentally changed. CoBank came out with a study last year on our projections on where ethanol is going to recover since CoBank is the major lender in the ethanol space. Our projection back then was that we're going to come back to about 90% of where we were pre-COVID on ethanol production. And that's about where we're at right now. The green line is about 90% of where we were pre-COVID. So what does this mean? Fewer bushels of corn and soybeans, or excuse me, corn and sorghum being used for ethanol. The EIA has indicated also in their view that consumers will continue, or drivers will be fundamentally changed also. The rebound we're going to see this summer will be a positive, but it's not going to be to the levels that we saw pre-COVID. This will impact ethanol and corn and grain sorghum usage. Live cattle and lean hogs have really had a bad go of it, especially back, you all may remember back in April when we had March and April when we had the packers shutting down, causing a lot of consternation, and cattle prices collapsed, hog prices collapsed. We are now back to pre-COVID levels, thanks to China mostly, but the food service sector is reopening. But we can owe a lot of this to the recovery and demand from China. One chart on that, as you can see here, I think this is a pretty interesting chart. It boggles my mind every time I look at this. This is China's imports of beef, pork, and chicken in 2020. There is no comparison. This is not because of COVID. It is because of the other virus, African swine fever. And as they continue to rebuild their herd, are struggling to teen and poultry. A couple quick charts on dairy. I think there might be a couple people in the room on the webinar concerned with dairy. I like looking at the dairy charts because it's a leading indicator of the economy. When restaurants are reopening, what do they have to do? They got to buy a lot of cheese and butter. And if you look at what's going on in these each of these markets with milk, cheese, butter, and the powders, you're seeing a recovery in prices there. This is all in context, folks. We've got no shortage of milk or dairy products in this country. From a supply side standpoint, there is no reason for prices to be recovering. It is 100% driven on demand. And this is, again, owed to the fact that we've got the economy recovering, people going back to restaurants, and quarantine laws loosening up. And so as we move through the spring and summer months, food service demand is going to continue to recover, and this is going to be a positive for dairy in the next few months because we got a lot of inventories we got to chew through. As you can see, this chart on the right, just an absolute huge supply of both cheese and butter. Last few charts here on the ag economy, and then we can perhaps open it up for more discussions. So clearly, the higher commodity prices are going to be driving recovery in net farm income from the marketplace. USDA is projecting a lower net farm income in 2021, but it's not because of the commodity markets. It's because Uncle Sam is going to be stepping back from the phenomenal role that they had last year from MFP payments, PPP loans, the CFAP payments, just phenomenal federal outlays last year. It's going to be expected to be smaller this year, but keep in mind where we're at, what USDA is expecting. Compared to prior years, USDA normally had about $8 to $9 billion in federal outlays. Even with a smaller footprint this year, it's still bigger than what we've seen historically. So net farm income still is phenomenally high compared to where we were in years prior. This is looking at cash receipts across the sector. Farmers and ranchers are expected to be paid more for the products that they grow and raise if they're going to be benefiting from higher commodity prices. The downside, though, is with higher commodity prices, we've seen a long-term trend in rising production costs. This has been an ongoing story. It just kind of inches higher every single year. And we think that USDA is probably a little bit conservative on what they're projecting in 2021 on agricultural production expenses. If you don't believe me, just call up the co-op and ask them about the price of fertilizer. It is through the roof. So these numbers are probably going to be revised going forward. This is the downside. So although commodity prices are higher, the agricultural production cost side of the balance sheet, that is probably going to be much higher than what USDA has projected in their latest numbers. That's going to erode farm working capital, but we're not there yet, where we've seen a phenomenal or a significant erosion of working capital. And remember, working capital is anything that is cash or anything easily converted into cash, like grain sitting in a grain bin. Over the years, working capital has been eroded from low commodity prices and rising costs. Things changed significantly in 2020, but USDA is projecting that trend to return to trending lower again in 2021. We'll see what happens in their future projections. That may dip even faster lower to the downside because of rising costs. Debt. This is an old story. I think we all know what's going on in the world. There's no declining amount of debt anywhere in the world, and agriculture is no exception. The question is the nature of the debt. If you look at the blue line and the green line there, the green line is non-real estate debt, things like operating loans, whereas the blue line is real estate debt. That's going to be your term debt. And for the past few years, farmers have essentially been borrowing against their equity to stay in business. And during the pandemic, with all these federal outlays and higher commodity prices, a lot of farmers paid down their debt. And so we're probably going to see this number come down a little bit. But if production costs continue to go up, and if we see a correction to the downside for any reason on commodity prices, then we're going to be back on this trend again of farm debt going back up. Rounding out the slides here, the positive is that interest rates on farm loans have been trending lower. That's been lifting a lot of the financial burden off of farmers and ranchers. A lot of this just follows what the Fed does. Look at that bottom red line there. That's the Fed funds rate. And if you look at those top lines, you see the Dallas Fed, Kansas City Fed, Chicago Fed, and Minneapolis Fed. They do surveys of community banks in their districts about what interest rates are with farmers and ranchers, and they follow pretty closely to the pattern from the Fed. So as long as the Fed is going to be keeping interest rates very low, this is a positive in ag. We're going to continue to see lower farm operating loan interest rates. There hasn't been any, this is just some quick data from the Farm Credit System. Loan volume continues to go up, whereas the non-performing loans as a percentage of gross loans has been very, very weak over the years. A very interesting scenario there. There really hasn't been any significant stress borne out in these numbers. We can probably anticipate non-performing loans to go down. This is looking at Chapter 12 bankruptcy filings. If you look at 2019 and 20, Kansas is the green part there. I brought that out for everyone to see. Those have been going down. In 2020, bankruptcy filings dropped. We're probably going to see bankruptcy filings drop yet again as farmers benefit from higher commodity prices and a fairly strong presence from the federal government again. And last couple of slides here, no indication of any farm stress. As a matter of fact, with the way things went with farm income last year and the way they're expected to go this year, no change here on the debt to asset ratio, which is a lagging indicator of the farm economy. Cash rents have been fairly stable. This is the latest data from USDA in 2020. I want to point out the survey data here was released in September. Things changed quite a bit, and cash rents have probably come up in a lot of areas. So don't let this chart fool you. They've been stable to higher pre-pandemic, but cash rents are probably going to go higher further with commodity prices. And Bob's shaking his head. He's probably got some ground truth on that. Farmland values, again, the story is not told in this chart because the data has not been gathered yet from USDA, but I think the news is out. A lot of areas around the country are seeing phenomenal rises in farmland values. It's a pretty hot market in a lot of areas. But this is all in context. You want to look at the capitalization rate, which is the cash rent divided by the land value. And when you look at this chart here, this is the cap rate in Kansas and the surrounding states. Compare that to the return on, or the yield on, say, the 10-year treasury, which is a safe asset. If you are an outside investor, look at your returns that you can get on the treasury. They're still very, very low compared to what you can get in farmland. Now, yes, here recently we've seen a turnaround in yields, but look at where we're at with capitalization rates in farmland, and it doesn't really. Farmland is still a stronger investment, so that's going to continue to attract outside investors into farmland and provide further support. With that, just a few thoughts. A couple things that we're going to be keeping our eye on, and that's the value of the U.S. dollar. A lot of that hinges on how the U.S. economy recovers from COVID, and if we see new variants that cause future shutdowns, future quarantines. We're going to be keeping an eye on that because the economy will slow down on that. That would weaken the dollar. But right now, we've had great success for the most part on vaccine rollouts, and we're doing better than a lot of other countries around the world. And so our dollar is probably going to strengthen as a result of that. Watch the Chinese. They're great friends right now when they're buying, and then when they don't need you, they disappear. We'll see what happens with the Chinese as they rebuild their hog herd, but their economy is doing very well as they recover from COVID. And that means a lot more consumption, a lot more agricultural imports potentially from the U.S. But one day they are going to slow that down. We're going to see an interesting crop acreage battle play out this spring. A lot of you have already made your plans on that. But we also have to watch what's going on with weather, especially in a lot of exporting countries like Brazil. Specifically, their safrinha corn crop. If it remains dry in South America, that could drive commodity prices yet higher still. That's not great news if you're in livestock or dairy production. Feed costs are probably going to go higher if you haven't bought your feed. Not good news there. So that's going to erode margin in that sector. Same thing with ethanol. If you're in ethanol production, not great news when corn is going towards $6 a bushel. That's not fun. But great if you're a farmer and you're selling it. So you take one with the other. And with all this liquidity and things going around with the world as they are right now, it appears as though we're going to continue to see strength in farmland and lower interest rates going forward, which is going to provide further support to the farmland market going forward. So with that, I think we are out of time. Sorry if I rushed it there at the end. Any comments or questions? Or tomatoes?
These are great slides, Tanner. Thank you for presenting the information and lots of ground. You covered a lot of ground in these slides.
Well, thanks. Well, we can send these out later if somebody likes. These slides are free to share if you want to look at them further.
Yeah, and I'd welcome if you want to unmute anyone who may have a question or comment, anything you want Tanner to expand on that hasn't been had a question yet, please feel free to do so. I mean, we've had some pretty good discussions in our prior cafes, and we welcome you to do that if you have anything to say or questions to ask.
On stage, can you hear me?
Yes.
Question. Back in the 70s, I didn't know it, nobody knew it. But now you can borrow money from the farm credit system that say 385 long-term. They typically dividend some and get it down to 285. Presume a farmer's in the 30% tax bracket. Now you're down to 199 after tax. As long as inflation is above 2%, they're paying you to borrow the money. Is that not true? Should we borrow ourselves rich, or can we borrow ourselves rich?
Bob, you can have this one.
Oh, thanks, Tanner. That's an interesting, I've never heard it pieced together all the way like that, but right now you're right. You're accessing money at close to all-time lows. I'll go back. I started in the mid 80s, and I remember we had some old federal land bank loans that were made in the 60s, and they were 5.5% fixed and 6% fixed. And I said, man, we'll never see rates that low. And today, I think in our portfolio, 75 to 80% of the real estate mortgages are a fixed rate. And in this last cycle, I think a lot of them start with a 4 and maybe a 3 if they're new, like you said. So the cost of borrowing is really low. It's fixed in. I think that's the difference between now and what happened in the 70s and 80s when all the farm debt was variable. And now it's mostly fixed except for your operating credits. So there's some power in the leverage if you're using it for constructive stuff. So yeah, you can still get in trouble, but if you're buying it for productive assets, I think you got a head start.
A great question. It's inflation was one of those things in the 1980s. I think people point out that saved a lot of farmers. It was so high, even though interest rates were high, but inflation for some people would point out that was a benefit to a lot of farmers.
Alan again. The question is, in 65, they made the guns and butter decision. Inflation took about 5 or 6 years to hit. But the deficit was nowhere near what we're doing now. This seems to be much more explosive. The velocity of money is terribly low. As soon as people feel that there's inflation, aren't they going to try and spend it as fast as they can before it loses value? And then the velocity will change. There's a whole series of unknowns out here. I've never quite seen a situation like this before.
Yeah, I didn't have a chart on the velocity. Thanks for bringing that up. The velocity of money. If you look at that, if anyone's, I'm not sure how many people know what we're talking about. Velocity of money is how fast the dollar changes hands, and the velocity of money completely cratered. It just fell off a cliff, and that is going to reverse. You've got consumers sitting on this stockpile of cash, if they have it, because the savings rate is so high. And then you've got some of these other issues going on. You get the stimulus checks, people that's going to spur some spending. And then what happens with a potential infrastructure bill? That could stimulate spending as well. But just the savings rate alone, I think there's about $2 trillion in savings that the consumer is sitting on right now. Once those people open up their checkbooks again, it could be a rebound, one of those V-shaped recoveries in the velocity, and that's what's going to drive. That would be the driver of inflation. But what that looks like, I mean, it can be a mild recovery. We don't know. The economy is different.
And when you think about all the uncertainty that's out there, and I think, Tanner, you said it a few times, we're kind of in uncharted water, and that's true. I guess what I think is the whole focus today needs to be on protecting margin and figuring out individually, what's your cost of production? What do you need for family living that you need the operation to pay for? What's your debt service requirements? And just have a keen eye on what the markets are providing for opportunities and pull the trigger when you can, because it's all about protecting margin going forward. Because what Tanner said a minute ago, our input prices are already going up. We think cash rents go up in 21 because the landlords missed the fall of this year. Prices weren't quite rallying like they did. We think rents will probably go up. And so when you look at the impact of higher prices, we'll have higher costs. So it's all about protecting your margin, we think, and trying to take some of this volatility out of your operation, because we don't know what's coming. It's going to be crazy.
Tanner? Can you
Hey,
hear me?
Mom.
Hey, so has the price of corn peaked? Tanner?
You can take that one.
Well, we have to see what happens in Brazil and what
Okay,
happens in the planting season here, Mom.
well, why
and everyone.
aren't the cattle feeders feeding wheat rather than corn, since wheat is cheap?
A lot of people may not have experience. We actually wrote a paper on that some time ago when wheat was under $2 cash out in Western Kansas.
Yeah,
And we wrote a paper up. That paper's dated. It's been 4 years now, or about that. Not everybody wants to feed wheat because it's complicated. I mean, you can if you don't do it right and you don't have any experience with it, you can kill cattle by feeding them. They get acidosis. So it doesn't matter for some people. The price of corn versus wheat doesn't matter. And you can't turn wheat into ethanol. You can't run that wheat through an ethanol plant. And if you don't have any experience feeding wheat, for a lot of people, they just don't have that experience. It doesn't matter what the price of wheat is. They don't want to mess with the animal's diet. Now, some people if they've got experience doing it, they're going to do it all day long. But they just got to be careful with the animals.
is there enough of a supply of wheat to feed it if they wanted to?
Well, the supply situation on wheat is not the same as corn because the Chinese have been buying more corn than they have wheat. So the stocks situation for wheat is different. The balance sheet is a lot tighter on corn. So I think, I don't know, I'm sure some people may be forced into the situation of looking at feeding wheat if corn keeps going up, and if we have a hiccup in this weather this planting season, with the balance sheet that we have, it could get really interesting. Once we head into the weather market, we're absolutely going to see that volatility. And so that may prompt some people to say, enough with corn, I'm going to go to wheat.
Talk.
Tanner, there's a couple other questions here, but to kind of piggyback off of that, there's a couple of beef processing plant startups happening. What kind of impact do you see that happening? What do you see happening as a result of that to markets and kind of what we've seen? We had the Tyson fire, and just how do you see that play out?
So those new plants, some of those are I can't name names, are borrowers, and that was born out of COVID, and moving those plants closer to the consumer. Now their cost structure isn't going to be the same as, say, like a Tyson, who there's going to be slaughtering many thousands more cattle or many more thousand head per day than a smaller one. But what it's going to do is build more flexibility into the supply chain. That's really the idea there. After having experienced COVID and the shutdowns that we saw, the industry said we can't afford to do this again. And so some smaller plants are being constructed as a result of that. Now we're going to assume that their customer is going to be there for them, not just through COVID, but longer term. And so even though they may not have the economies of scale of a bigger plant, they're going to have that local market there. excuse me, to serve to for them to be profitable, long as build more flexibility in the supply chain.
Thank you. Jennifer's got a question here regarding beginning farmers. How will they get their foot in the door? What does this mean for beginning farmers who may not have the borrowing power of their parents or grandparents? Is this a better time for beginners to borrow? What does it look like for somebody who's just getting into the business?
Well, Bob may have some younger borrowers and can talk about that at a from his vantage point. But when you've got interest rates at historic lows, you're not going to ever be able to time markets very well. The timing it, if you're waiting around for a correction in land prices to buy a farm, you're going to be waiting for a while.
Mm-hmm.
Whereas your borrowing costs are going to be long or are here now very, very low. So if you're in a position, just kind of like everybody, to take advantage of lower interest rates, this is the time to do it. The problem is the appreciation of assets, of all assets, whether you're talking about farmland or houses or the stock market. Everything is getting more and more expensive. And if you're a younger person, it's getting that wall that you got to climb. That barrier to entry is getting higher and higher and higher. That's the only thing. And so my only thought on that is you're going to have to go get an off-farm job or something in order to afford potentially a purchase, or just wait for a family member to pass away so you can inherit it.
Well, the other thing we've seen lately in the last, I'd say 5 years is especially on grain producers, they want to bring the next generation home. They didn't really focus on buying more farm ground. They maybe are bringing livestock back into the operation, and we're seeing some confinement facilities go up. We're seeing some integration with that, and we've seen a lot of that over in the eastern part of Nebraska, Iowa, South Dakota, and some in northeast Kansas. But adding livestock back to the operations has been one way to bring the next generation back in, and it's worked so far. It's been working pretty well. But if you're just starting out on your own, everybody knows how capital intensive ag is. You've got to have margin, because it's hard to have high leverage in agriculture.
Tanner, what do you see with regard to protein consumption? With all the stimulus payouts that have happened, what have you seen from a consumer protein consumption? And has that shifted much with the COVID outbreak? And as people have gotten stimulus money, have they increased their protein intake between beef, pork, and poultry?
Well, I can definitely say how they consume their protein has definitely changed. And because you got two things going on. They haven't been able to go to a restaurant, and they have more disposable income now because they've been spending it on all these other things like clothes and commuting and what have you. So they're able to spend it more on ingredients. So they can afford to buy that steak or buy more steaks for home consumption. They're probably eating more steaks now than they ever did, because they're not going to the restaurant or the steakhouse to eat it, but they got this disposable income, so they're going to eat it at home. They're going to have that culinary experience at home because they can't get it anywhere else. And so a lot of these consumer habits are expected to continue, where people got used to having this disposable income and spending it on themselves at home, that they're going to keep eating not just hamburger, but a steak, or having more fillets, things like that going forward. So a lot of remember, those are the people who throughout the pandemic kept their jobs and had disposable income. For all those people who don't have jobs and that are probably going to be sidelined from the economy longer term, that's a different story. Their protein consumption isn't going to be the same. If they eat protein, they're going to be buying down, probably more chicken, things like that, more hamburger.
Sure. Kelsey, I think you had a question here. What do we do now to take advantage of the current economy or prepare for rocky times ahead?
Stockpile toilet paper, ammunition. Uh, oh, I don't know. That's an interesting question, Kelsey. Well, there has been a lot of stockpiling. That's been a new thing. Where the prepper phenomenon that kind of went into hyperdrive. People storing more food, shelf-stable food at home. Big deep freezers in more homes. So a lot of people are doing that. But I don't know if that's answering your question, Kelsey. How do we prepare for tougher times ahead? I think when you look at the data with what consumers are doing now with their frugality and saving money, and they're more frugal than they were before. I mean, I think these are habits that people have adopted because they're psychologically they've been changed and they're preparing for more trouble ahead. I think more people want to be prepared for more supply chain shocks. And so there's probably going to be more stockpiling like that at home, more saving, more that kind of stuff. I don't know if that answers the question, but that's how people are preparing.
I think
And pay down debt.
Alan States, can I make a comment on that?
Yes, please.
What I'm seeing out here is farmers have had some tough times, and they've made the equipment stretch out as long as they can. The repair bills are going up. One way you can stockpile here right now is trade the hell out of equipment, finance it on long-term fixed rate, maybe on real estate, because next year it's going to cost you more to replace it. You're better off doing it now.
If you
There you
can
go.
get the parts.
Oh, true. Yeah, if you can get the parts.
Yeah.
Well, that's one thing we've heard here is if you don't have good equipment and you've stretched it too long, some of the equipment dealers are not going to be able to get you a spare part. So that could be fatal. So that's another problem out there.
Yeah. Goes back to stockpiling. It's a good point. Or preparing, having those parts there when you need them.
I had another question in the chat about back on the processing. I know that I presume you were talking about some of the mid-sized processors that we've seen in the news that have announced that they're expanding. What do you foresee there being an impact by the small custom or small state inspected plants? I mean, there's been a huge uptick across the country and number of states that have seen an increase. I mean, Kansas is, I think I looked at our numbers, we have maybe 20 more that are coming on board or close to 40 that have expressed interest. What does that look like at the local economy, at the state level, national level from a small processing perspective?
We're talking about animal processing.
Yeah. Primarily.
Yeah. Well, invariably, I mean, it's going to be more local activity for the local economy, and just creates from the rancher perspective, that local plant is going to be another bid on the cattle or on the hogs, so that might add more support to local cash prices. But this is going to be really interesting. I mean, you're bring up a good point, Kelsey, about the amount of increase in processing, and perhaps we may be getting overbuilt. That happened with ethanol. When we had the ethanol craze, we built way more ethanol capacity than this country ever needed. And what happened? A lot of your smaller processors lacking economies of scale were consolidated, and they were bought by your larger plants like ADM. And I would imagine, I mean, it depends. It's got to be a case by case scenario, but I would imagine as markets go, as economics go, it will be overbuilt, and someone's going to get consolidated, would be my assumption.
We've seen a lot of beef producers
What
who
that looks like, I don't.
Oh, sorry,
Go
I
ahead.
think there's a delay. We've seen a lot of beef producers that have entered that direct to consumer market. And I wonder how long that consumer trend will last, is wanting to purchase local, and if that will be supported by that local processing capacity. We're talking small, like maybe tops 50 head a week, right? Or less.
Oh,
Um,
goodness. Yeah.
eh, I
I mean,
don't know if that's a trend that will last, or if it's just a kind of a COVID cycle.
It's a good, I think that's a good question, Kelsey. And I've wondered that same thing. Like, Shop Kansas Farms has had such a boom and attractive customer base it's built in this past year. And are people going to keep after that almost artisan kind of food consumption, or will it go back to what it was before?
I don't know.
Um,
That's a really good question. I mean, what do you compare it to? If you want to do a comparison to some other market, I mean, like organic, that consumption continues to go up. And so maybe, there's other things going on here beyond just economics, and the price of, steaks or hamburger or what have you. It's a lifestyle or a consumption identity type thing. Maybe maybe that's being born out of this. I don't know. I know that like Walmart has gotten into this with a identity preservation from the ranch. They actually built their own slaughterhouse. This is out in back east, Atlanta area. It's southeast, and it's all Angus. They kill the cattle, they pack them, and and then it's directly to the stores, and it's at a higher price. And they did that. I mean, Walmart doesn't do something unless they know it's going to make money, and they went big on this. They know this is going to work, and so they've got this identity preserved Angus product in Walmart stores that is priced differently than the other beef. And if that's an indication of what's going on nationally, I would assume that some of these plants are probably going to be successful. I don't know that all of them will be, but there's probably something to it. People may not just want their locally grown asparagus; they want their local cattle as well, or local beef, local pork.
Walmart's purchased up a portion of capacity at one of our mid-size processors in Kansas, actually.
Really?
I
Oh, how
they
about
took
that?
up, yep. I think they took up some of the food service capacity at one of the facilities, and almost have secured a large, more than 75% of their current processing capacity.
Wow.
I don't know if it was just a supplement while the other plant came on board, but it was an interesting move. Something recently I learned. So
Huh. I mean, this is not something new for Walmart. I mean, they built their own dairy processing facility in Indiana. I mean, they're connecting all the dots. And so, no, I don't know. I think there's probably something there that if Walmart's on it, then there's something there.
I changed topics for a moment. I wanted to know if anyone has any more information about the Larry Steckline was on the noon news today with his FSA director from Sedgwick County that telling us that we're going to be getting $20 an acre from the government due to the COVID situation. And my question is, what acreage are they talking about? If in fact, is this production acres? Is this CRP acreage? Is this the whole farm? Does anyone have an update on that? Any more information?
Oh boy. I apologize. I don't have any deep insights right now. Our folks in DC, or we have an office in Washington DC. They probably have that information. I did not call them before our discussion for this evening, so I don't have any thoughts on that.
Yeah, I don't
Kelsey,
either.
I think just asked about. Go ahead, Rob or Bob.
I say I don't either. So
It appeared in our checking accounts last week miraculously.
Oh, it did? It's already there.
It's already
Alright.
there in some cases,
Yeah,
depending on
believe
how you
that's
signed
right.
up for prior programs. So
okay.
check with your FSA.
They said something about if you were already signed up, that you'd be getting that payment. So I didn't know, Alan, what's going
must
on.
be CFAP. Yeah.
It's true.
Okay, thanks.
Other questions? You know, Doug's got a comment on here that Carl is going to have a gun drawing for a commemorative gun. So be sure and get one of those tickets so you have a chance to win when we start that up later this year in a few months. That's like a good board member right there, Doug. Great job. And then I think Jill and I and the rest of the Carl family would be remiss if we didn't thank Farm Credit for their support for the Carl program, and especially what it's meant to the current class to have the Gettysburg leadership experience.
Yeah.
That resonated very well. Transformational leadership. It was a great experience when our class was there last February, and we're thankful and grateful for that support. So thank you to Farm Credit for supporting the Carl program.
Yeah, you're very welcome. We work really well together and we appreciate the partnership. So thank you very much.
Any other questions? Tanner, Bob, great presentation. Anybody who wants to stay on and talk more about this, you're certainly welcome to do so. Jill and I'll hang around and we'd be glad to talk further with you wherever that discussion goes.
Well, thanks everybody. And I hope 21 turns out to be a great year for all of you. So